Two investors start with the exact same amount of money, $50,000. They also share the same goal to generate reliable income while growing their wealth over time. Jake chooses what appears to be the smarter investment. He puts his money into a professionally managed fund backed by respected names on Wall Street. The fund promises an impressive 11% annual yield, with distributions deposited into his account every single month. Jake does not need to sell any shares. He does not need to wait for the market to rise. He simply owns the fund and watches the payments arrive like clockwork. Marcus takes a very different approach. He invests his $50,000 in a plain, boring index fund. No double-digit yield, no sophisticated strategy, no exciting monthly payments. From the outside, Jake appears to have made the better decision. But 3 years later, the results tell a completely different story. Jake's $50,000 has grown to approximately $57,800. Marcus's investment has grown to about $78,300. The investor who chose the boring index fund now has roughly $20,500 more than the investor collecting an 11% yield. So how can someone receive such a high yield and still finish so far behind? And more importantly, was all the income Jake received actually backed by real cash? To answer that, we need to follow the money and uncover where that attractive 11% yield truly comes from. First, this is not a high-yield savings account at a bank. It is not government-insured cash sitting safely in a deposit account. And it is not simply a traditional bond fund whose holdings are bought and sold publicly every day. Jake's fund operates in a different part of the financial system known as private credit. In simple terms, the fund collects money from investors and lends it directly to private companies. These are often mid-sized businesses. They may be too large for a typical small business loan, but too risky, too complicated, or not financially strong enough to borrow money through traditional channels at a low interest rate. But these companies still need capital. They may need money to expand their operations, purchase new equipment, cover rising expenses, refinance existing debt, or simply keep the business running. Jake's fund provides that money. In exchange, the companies agree to pay a much higher rate of interest. The fund collects those interest payments and distributes a large portion of the income back to investors like Jake. That is where the attractive 11% yield is supposed to come from. And under ideal conditions, the system can work exactly as promised. When the economy is stable, business revenues are growing, and borrowers make their interest payments in cash, the fund receives real money. The company pays the fund. The fund keeps a portion of the income and passes the rest to Jake. Real cash comes in, real cash goes out. There is nothing artificial about that process. But the system depends on one critical assumption. The borrowers must continue generating enough cash to make their payments, and that is where the trouble begins. Sales start to slow. Operating costs begin to rise. Existing debt becomes more expensive. The company's profit margins shrink, while its monthly obligations remain the same. Eventually, one of these businesses reaches a point where it can no longer afford to pay the interest it promised, not in actual cash. In a normal lending relationship, that missed payment would immediately signal financial distress. But inside some private credit deals, the borrower may be given another option. Instead of paying the interest in cash, the company is allowed to add that unpaid interest to the balance of its loan. The payment appears to have been made on paper, even though no cash has actually changed hands. This mechanism is called PIK, short for payment in kind. And once PIK enters the story, the meaning of Jake's 11% yield begins to change. Because from this point forward, the fund may still report income. Jake may still receive distributions. His account may still appear healthy, but some of the money supporting those payments may exist only as a larger promise from a borrower that was already struggling to pay. And that is the turning point in this entire story. To understand PIK, forget Wall Street for a moment and imagine that you own a rental property. At the end of the month, your tenant tells you they cannot afford the rent. You have two choices. The first is to record the truth. The payment was missed, and the tenant now has an overdue balance. The second is to say, you do not have to pay me in cash this month. I will simply add the unpaid rent to what you already owe. Suppose the tenant already owes you $10,000. and this month's rent is $1,000. No cash is paid. Instead, the tenant's debt increases from $10,000 to $11,000. On paper, you now own an asset worth $11,000, but your bank account has not increased by a single dollar. That is the basic idea behind PIK payment in kind. When a company cannot pay interest in cash, the fund may allow it to add the unpaid interest to the loan balance. Imagine a company owes the fund $10 million and must pay $1 million in interest. If the company has no cash, the loan balance can simply rise to $11 million. The fund receives no money, but that unpaid $1 million may still be recorded as income on its financial statements. Think about what that means. The borrower did not send cash. The fund did not collect cash. Yet the fund can still report that it earned income. And the problem becomes even more serious when the fund must distribute most of that reported income to investors in order to maintain its tax structure. The fund may then pay Jake a real cash distribution based partly on interest it never actually collected in cash. In other words, the dividend appears in Jake's account, but some of the income supporting that dividend never appeared in the fund's bank account. The payment is real. The cash behind it may not be. The first risk is simple. Reported income is not always the same as cash. A fund can report strong earnings and continue paying regular distributions. But if more of that income comes from PIK, the quality of those earnings begins to weaken. Cash can immediately be used to cover expenses, reinvest, or pay investors. PIK income is different. It is only a promise that the borrower may pay more in the future. If the company recovers, that promise may eventually become real cash. But if the business continues to struggle, the unpaid interest added to the loan may never be fully collected. So the important question is not simply, how much income did the fund report? It is, how much of that income was actually received in cash? The second risk is how these private loans are valued. Public stocks are priced continuously by millions of buyers and sellers. Good news can push the price higher. Bad news can send it lower. The market may not always be correct, but the pricing process happens openly. Private loans are different. They are not traded constantly on a public exchange. There may be no active market showing what investors are willing to pay for them today. Instead, their value is often estimated using financial models, company data, and the fund manager's own judgment. Those estimates may only be updated once every quarter. This can make the fund appear unusually stable. But stability on a statement does not mean the assets are free from risk. A borrower may have been weakening for months while the value of its loan is reduced only gradually. By the time the full loss appears, the damage may have been building for a long time. The third risk is liquidity, the ability to get your money back. Many investors assume that because they bought an investment fund, they can sell whenever they choose. But private credit funds often do not work like ordinary stocks or ETFs. Investors may only be allowed to request withdrawals during specific windows. The fund may also limit total withdrawals to around 5% of its assets per quarter. When markets are calm and few people want to leave, that restriction is almost invisible. But when bad news arrives and many investors rush for the exit, the limit suddenly matters. Imagine investors request withdrawals equal to 15% of the fund, but the fund only allows 5%. Not everyone receives all the money they requested. Some withdrawals may be delayed until the next quarter, or even longer. Investors are left waiting while the assets inside the fund may continue losing value. The investment that looked safe and stable now has an exit door that opens only a few inches at the exact moment everyone needs it most. That is what sits behind the attractive yield. Income that may not be cash, asset values that may only be estimates, and money that may be difficult to withdraw when conditions deteriorate. Now, let's return to Jake and Marcus. Both investors started with the same $50,000. And to make the comparison fair, we are not ignoring the income Jake received. We will assume that both men reinvested every dividend and every distribution paid into their accounts. Because the number that matters is not simply the dividend yield, it is total return. Total return includes every dividend you receive, plus any increase in the value of your investment, or minus any decline in that value. After 3 years, Jake's $50,000 investment grew to approximately $57,800. Jake still made money. His total profit was about $7,800, representing a gain of nearly 16%. But during the same period, Marcus's $50,000 in the index fund grew to approximately $78,300. Marcus earned about $28,300, giving him a total return of roughly 57%. The difference between them was more than $20,000. And that is what makes Jake's results so deceptive. Every month, he saw money entering his account. Each distribution made it feel as though the strategy was working exactly as promised. But while cash was being paid out on the surface, the value of the investment underneath could still be falling. That is why a high dividend yield does not automatically produce a high total return. Imagine a fund pays you an 11% yield, but its share value falls by 8%. Your real result is not 11%. Your total return is closer to 3% before taxes, fees, and other costs. Meanwhile, another fund may pay a much smaller dividend, but experience far stronger growth in its underlying value. That investment can leave you with significantly more money, even though it never offered an exciting monthly payout. Jake focused on the income being deposited into his account. Marcus focused on the total value of what he owned. And after 3 years, the final account balance, not the headline yield, determined which investor had actually built more wealth. Jake received the larger yield. Marcus finished with the larger fortune. The lesson here is not that every private credit fund is bad. And it does not mean that an index fund will outperform in every market or during every period. The more important lesson is this: a high yield never appears from nowhere. If an investment pays significantly more than the rest of the market, there is usually a reason. It must offer that return to attract your money. The higher yield may be a reward for accepting greater risk. But before collecting that reward, you need to understand exactly what kind of risk you are taking. Before investing in any high-yield fund, ask 6 questions. First, where does the money used to pay the dividend actually come from? Second, was the fund's income collected in cash, or was part of it simply added to the borrower's outstanding debt? Third, is the percentage of income coming from PIK increasing or decreasing? Fourth, are the assets inside the fund priced by an active market or estimated by the fund manager using financial models and judgment? Fifth, can you withdraw your money whenever you choose, or are redemptions limited to specific monthly or quarterly windows? And finally, after adding the dividends and subtracting any decline in asset value, what was the fund's actual total return? Do not let a monthly payment distract you from the total value of your account. Do not confuse income reported on a financial statement with cash that has actually been collected. And do not assume that a respected Wall Street name can remove the risks built into the investment itself. The next time an investment promises to pay twice as much as the rest of the market, do not only ask, "How much will I receive?" Ask a more important question. What must continue to be true for this yield to remain sustainable? The borrowers must continue making their payments. Reported interest must eventually turn into real cash. The value of the assets must reflect their true condition. And the fund must have enough liquidity when investors decide they want their money back. If any one of those conditions stops being true, an attractive yield can quickly become a trap. Jake did not fall behind because he received no dividends. He fell behind because he focused on the money being paid to him while ignoring the value disappearing underneath. Marcus did not win because index funds are magical. He won because he focused on total return, transparency, liquidity, and assets whose prices were determined openly by the market. An 11% yield is not automatically a gift. Sometimes, it is a warning label written in the language of money. So do not simply ask how much an investment is paying. Ask where the money used to pay you is actually coming from. Because numbers on a statement can be delayed. They can be estimated. They can be adjusted, modeled, or presented in ways that make an investment appear healthier than it really is. But mathematics does not care about appearances. A weak borrower does not become stronger because unpaid interest was added to its debt. A loss does not disappear because it has not yet been fully recognized. And an unsustainable return does not become sustainable simply because the payments continue for another month. The math is still the math, and bad math does not disappear. It only waits until the truth can no longer be hidden.